Felix here, and you might have all seen this rather large thumbnail of Tom Nash saying Sofi $100. I encourage you to watch that video, by the way. And this is not a takedown in any way, shape, or form, but I think it's worth having these conversations and getting a different perspective. So is Tom a bear or a bull on Sofi? What is Sofi worth in 10 years? What return can you expect per year? Where is Sofi's current support line in the chart? Because you might have noticed it's coming down quite a lot. And how could we trade Sofi? That's basically what I want to cover here in this video. So we'll do exactly that. And of course, none of the following is financial advice, just an old banker sharing with you his thoughts. Before we do that, make sure you sign up for the live trading on Wednesday, 11 o'clock. We be trading live. You get my full strategy live. You get a workbook. You get to see me trade live. You get to ask me questions, but it's private. So you got to go to felixfriends.org/webinar. 1,000 people will join me. It's going to be a blast. Sign up for that while there's still some spots available. So, all right, let's move Tom's rather intimidating face off. So I've got a whole spreadsheet here for you, which again, you can download for free at felixfriends.org/Sofi. That's felixfriends.org/Sofi. Put the link down below so you don't have to type. I know that's a challenge for some of us. And I want to go dive into these numbers here. But before we do, there was one thing that really stuck out to me. And Tom ran through the numbers rather aptly. And he said, look, the price to book ratio of Sofi is 1.4. So it's only worth 1.4 times its assets. And you might be thinking, well, that's super cheap, right? And then the price to sales ratio is 4 point something, which, not crazy, not NVIDIA levels, but why is that? And I thought I'd ask my new friend, Google Bard. I now have two friends, Winston and Google Bard, and it gives you the numbers. And I wanted to illustrate to you that banks have very, very low price to book ratios. And why is that? JP Morgan is valued at only 1.3 times its balance sheet value. Wells Fargo, 1.2 times its assets. Citigroup, 1.2 times its assets. That's really cheap, isn't it? Why is that? It's very simple. We don't trust banks. We don't trust their balance sheets. Wall Street does not trust balance sheets. And it's the bankers essentially who said it. And they know, well, we know what's on our balance sheet. I certainly don't trust the competition. And that's something to bear in mind. So Sofi trading at 5 times price to book, according to Google Bard. Data isn't always accurate. Tom might have the better data on that one here. Let's type that in. Sofi price to book. I'm intentionally not using a paid service here because appreciate not all of you have access to things like that. So unlock my access. They want me to pay for it. I'm not going to do that. Are we? Sofi is, that's the share price to book 1.5. So it's probably more like 1.5. I think Google Bard here has got that number a little bit off. But the point being, it's basically valued like a bank. So that's kind of, from that point of view, rational. Now, price to sales is definitely higher. And again, I think that data is a little out of date, but it's more in line with your PayPals or a little bit cheaper than Square or your Visas than a bank, because the market kind of views it more as a tech business. And the message hasn't really arrived yet that this is a bank. The memo hasn't landed. So what's this sheet that I'm sharing with you? So you can play with this. So this up here is the share price. It pulls it in automatically. How many shares are out there? The market cap. And then the sales in the last 12 months is about $1.7 billion. And what we do here then is say, like, well, what's their growth rate going to be over 10 years per year? Each year of the 10 years. If it's 15% and at the current price to share multiple of 4 and a bit, 4 or 5, the company will be worth sort of 27 to 40 billion, something like that. If they grow at 45%, well, it'll be worth like 10 times as much, 275 to 400 billion. So big, big, big difference. And how much have they been growing lately? Well, quite a lot, actually, 40, 50%, maybe even do a little bit more this year. But is that likely to continue for 10 years in a row? I think, if you have to be honest with yourself, that very few businesses grow 40% per year for 10 years in a row, because the compounding is insane, right? It takes you from a teeny tiny business, which is what Sofi is at the moment, to an absolute monster. So I would sort of err in the middle somewhere. And then also there is the little hideousness of dilution. Yes, Sofi dilutes. If you want to look that up in a chart, you can see down here, and I appreciate I'm blocking some of this. So I'm blocking even more of it now. Can I move myself? I'll move myself. Felix's large head moves out of the way. So down here in tradingview.com, there is something called, what is it? Diluted shares outstanding. Here we go. And it's, I think it's probably free. So you can see each quarter how much they're adding. And essentially they're adding about 3%, give or take, shares per year that are outstanding. Why? Are they raising money? No, they're not raising money, but they are paying employees, sort of a little bit like Palantir, not quite as aggressively, but something like that. So 3% dilution. So in 10 years, we're not going to have 940 million shares outstanding, but we might have more like 1.2 billion shares outstanding. And that's important to understand. So what does that do to the 10-year price? Well, I've made, again, 5 tables here for you with the different dilution levels. It's possible they could tick up if they wanted to acquire something, for example, or they need more capital for one reason or another. Probably they stick around the 3 or 2%, I would think. So I'm looking at this table here, the 3% one. So if they grow at 15% at price to sales of 4, the share price is $21. If they grow at 45%, the share price is $217. So is it possible to get to 100? Well, theoretically, yes. You would need 35% growth, and you'd need a multiple around the 5 to 6 level. So it's possible, but it's a little bit of a stretch, I would say. And I think the numbers that Tom went through in terms of discounted cash flow are probably a little bit more realistic. By the way, I asked Google what they thought it was worth. And where did I do that? I asked them for the discounted cash flow model. Yeah. According to Alpha Spread, the DCF value of SoFi stock is $7.99 as of June 19th. That means it's 7% overvalued. So that's kind of the conservative middle ground here, right? So that's kind of where they're at. So say the share price is, on the worst case scenario, sort of $21 or something like this. This is in 10 years, right? Tom was putting out numbers in 5 years, so that kind of explains the difference here. Why in 5 years, you're never going to get to $100. It's just not going to happen. Forget about it. Never going to happen. No. Winston's more likely to not eat food that you put down, which would never happen. That would be a real tragedy. Be really worried about that. So expected performance. Now, again, go back to the chart here with the 3% dilution, because you want to know how much money you're making per year, right? So if the stock, the revenue grows 15% per year, and the share price to revenue multiple, the price to sales multiple, same thing, is only 4, which is less than what it is right now. So valuations multiples come down, and it's the worst growth rate that we would predict. You're still making 9.6% a year. Again, it's not a promise, not financial advice, but that's kind of the base case, which is pretty bloody good, isn't it? And then if it's more like our bullish case, what we're talking about just now, then it could be 28% a year. And you might be thinking, I don't want to make 28% a year. I want to make 10x. Well, it gets you there very, very quickly. Just put it into a compound calculator. Anything that makes you more than, sort of 15%, 20% a year is an absolutely outstanding wealth generator that you've never really seen before. So that's kind of the data. So you can play with that, and it's all linked together. So you can just go in here at the beginning, and you can change your your growth. If you think it's going to grow 60%, okay, in theory, you have $1 trillion business. Fairly unlikely. They could make acquisitions and stuff like that, but they'll probably be dilutive. I mean, there are ways to get there that might get you there. Now, a couple of other words before we dive into the stock charts. I'd love to spend a little bit of time on this here. Is institutional investors are at 37%. I think Tom is right on that. That's low. The problem is that SoFi is a disruptor of banks. Banks don't want to buy their competitor. Very simple, right? Why do they want to give them high price targets? Why do they want to buy them? They don't. So who are you left with? Well, what are other institutions out there? Well, there are big funds, there are pension funds and so on, have a lot of the money. But they kind of don't really look at SoFi as a bank. They sort of say it's some sort of neo-bank. It's kind of like risky. We don't really understand it. It's technology. We don't want that. If we want to buy a bank, we want to buy JP Morgan. If we want to buy technology, we want to buy, I don't know, Microsoft or something. Stuff they understand. So it's a challenge. And I think SoFi needs to grow some more to show that, yes, we are a bank. And yes, our customers don't default, and they kind of have to prove the model to those guys, because they are like old fuddy-duddy people in gray suits who get taken out to very, very expensive lunches and trips and dinners by JP Morgan. And SoFi probably doesn't do that, not enough. So, get the SoFi yacht. That might help, not just SoFi Stadium. Now, where is our current support here? If you look at this chart, let me just make this a little bit bigger. So what happened here? Well, we topped out here at 1020, right? We went up, down, and we did that previously at 820. So it's a higher high. That's kind of good news. The time before that, we topped out at 850, which is ironically exactly where we're trading right now. So these tops are kind of hard for us to break through. Now, this is the first one that kind of changes the story, because here we had a high and then we had a lower high, which kind of makes this into a bearish scenario. And we kind of like were forming these lower and lower and lower lows. And then we broke through the yellow line here, which is the 30-day moving average. That's always 50-day moving average. That's an important one. Broke through the long-term 200-day moving average. Still wasn't that excited about it. I got excited when we broke through 650 here, that last peak. And I was like, this is really something. We did that in one day. And then we smashed through the previous resistance lines here from these previous peaks. So that's all good. But now we're topping out. So what are we doing? How low are we going to go? Well, you could look at the chart and go, well, we typically break back through the 50-day moving average line, the yellow one here. We've done that, a couple of times. We did that over here. We did that here again. So are we going to do that again? Well, one place you can look for support data is go into your broker, type in Sofi, look in the options chain. You can do this in Webull or in Thinkorswim or whatever your drug pusher of choice is, Interactive Brokers, and all of those. And you click on the next third Friday of the month. So we always look at the third Friday of the month. Institutions only trade options on the third Friday of the month. They don't trade the weeklies in between. So the 21st of July is what we're looking at. And then on the left here, you've got calls. On the right, you've got puts. Now, because we're going down, we care about where the puts are. The puts are actually supportive for us. Where are people hedging their Sofi positions? And you want to look for the largest number. Now, the largest number sits very clearly at $7. $7 is the share price, or the strike price, as we call it in options. 46,000 contracts, each for 100 Sofi shares. That is 4.6 million Sofi shares controlled here by puts at $7. If you break through $7, these guys make money on those hedges, or maybe they were just bearish bastards. And they therefore will sell those puts, and that will trigger a chain reaction through market makers who sit on the other side of that trade, which means that they have to buy Sofi stock. So the market gets lifted up, or at least supported. So $7 is the big support line here. I'm going to make that green. Where did my colors go? Yeah, the colors. So that's kind of that, right? So that's the support. Is there any other support in between? Well, there is a fair bit at $8, something. Not a lot by $7 standards, but still 11,000 contracts. So that's a little bit of some support. I would say $8 is sort of a bit of a mini support line here. Not as strong as the 7 one, but it's still there. Now, if you then bounce back up, can we tell if there is a resistance on the way up? Well, you want to look on the left side and you want to go, well, where is the whole market positioned? Well, the market is still very largely positioned at $6, which is scary, at $7, which is not what we want, at $8, but there is some at 9 and at 10 as well. Is there any above that? Not that much. So probably the average of this is centered somewhere around the $8 mark as well. So I would think, without having done the maths here, that the stock gets sucked to about $8, because that's essentially where the market is positioned. So it's useful to look at this, and you might want to take a screenshot of this at least once a week and see how's it moving. Because if you know that these $6 guys disappear and they all move to 7 next week, then well, the market has moved up. The market's expecting it to go higher. Not the be all end all. It's not the there isn't one single data point or indicator that tells us everything. But this is definitely something that most people don't look at, and it's really useful. So how can you trade it? Well, you can go to optionswatch.io. Optionswatch.io. It's a platform that I'm building with a student of mine who's an ex-Twitterati, and he didn't get fired by Elon, by the way. He left way before to set up his own ventures. And here you look at Sofi, right? So this is the stock chart here in the middle. You can see IV percent is moderately high and probably picking up a lot as we're going down. So what could you do? Well, you could do a bearish trade if you wanted. That might go against your grain because you have a strong belief, but never let beliefs get in the way of profits. That's what I always say. But there isn't any, you could do something like this. So from the peak down, as long as we stay below $10.11, which has an 83% chance of making us money. Again, don't do this trade, I'm just illustrating. We would make a 12% return by the third Friday of July. It's sort of like, all right, it's nice, but given the risk, probably isn't worth doing, right? Could we do something bullish? Well, you could go, if you were a braver soul than me, you could go to that $8 line where we're seeing that support. And we have basically a break even at 773. Lower chance of profit, only 68%, but a heck of a lot more profit, 37%, right? So that's something to look at. But probably the safer place would be to be at 7. And because it's the safer place and it has an 83% probability of making you money again, it break even at $6.90. So stock could go down to $6.90 or go all the way up to the moon and you're still making 11%. So it's not like, it's not like the most beautiful trade in the world, but I think it's still, it's worth looking at these things, and you do sometimes find it. So why isn't the most beautiful trade in the world? Because we're kind of in never land, right? If we've just broken out, that's a good point. If we're just turning the corner and we're coming back down, that's also a good point. You're sort of somewhere in the middle, fairly close-ish to support lines. You're not going to get a huge amount of premium. So it's probably not something I would trade at this point. I think that about covers it, doesn't it? So $100 possible? Yes, 25-30% growth over 10 years consistently, which is less than they're doing right now, but still, it's going to get hard in years like 8, 9, 10. It's going to get hard. That's all I'm saying. So the question is, how much do they grow now and how much does that drag down the average? But even with a modest growth rate, the potential return still looks pretty good if these valuations stick around, 4x revenue. And as you know, market valuations and multiples change over time. But I like running through these things. I think it gives us some perspective, and then I don't base it on like the moon scenario what I do. And I think Tom's point of just like picking good stocks, or that you've done research on, that you follow, and slowly but gradually DCA into them in some form or another is definitely a smart point. So thanks for putting that out there, Tom. I appreciate it. And thank you for watching. If you enjoy Sofi coverage, subscribe to the channel, and let me know what you make of these price targets. Cheers.